It's a very famous saying by Warren Buffett which goes like, be fearful when others are greedy and be greedy when others are fearful. What that means is that we should buy when there's a lot of fear in the market and we should sell when there's a lot of greed in the market. In the stock market, where sentiments run very strong, fear and greed are important indicators that influence the whole market direction. We have all seen times of excessive fear where people start doing panic selling and that leads to sharper corrections, or more recently, times of greed where many investors keep on jumping into the rally and think that it will never end. In this video, I'll be going over the fear and greed indicators, our understanding of fear and greed in the market, how to interpret it, how to actually allocate based on this indicator, and how that can help you in your trading strategies. See, when we run our PMS strategies or other strategies in the market, a lot of clients come and ask us, please buy when there's a deeper correction, please buy when you're seeing lower prices. But what is the metric that you can track that this is the bottom, right? The fear and greed index, what it does is it ranks the market sentiment from a scale of 0 to 100. 0 meaning a lot of fear and 100 meaning a lot of greed. Any value of the indicator which is less than 20 means that there's excessive panic in the market. People are selling left, right and center, and there's a lot of selling pressure. Bears have taken over. On the other hand, when you see the indicator going above 70, 80, that means that there's excessive buying. People are extremely euphoric. They think that the rally is never going to end. But how do you define these numbers, right? How do you actually say what is fearful and what is greedy is something that we'll understand in the next section. Fear and Greed Index is made popular by CNN Money, which publishes this index in a very public site, and a lot of investors in fact follow that Fear and Greed Index in the US and try to time their entries and exits based on it. So what we try to do is we try to study each of those indicators and saw what is the impact of combining this and creating a Fear and Greed Index in the Indian market. So essentially there are more than 7 indicators that you can study. So the first indicator that they study is something called stock price momentum. What stock price momentum means is that they are trying to ascertain the strength in the stock price, and they are just simply taking the difference between the current stock price or current Nifty price versus a 125-day moving average. Whenever the Nifty is above their 125-day moving average, then it's in a strong trend, but the moment it starts slowing down in comparison to the long-term moving average, we are slowly chipping into the fear zone. Next thing that they look at is something called stock price strength, which is trying to understand the strength of the trend in the market. The interpretation of that is they are trying to see what are the number of stocks that are near their 52-week highs versus the number of stocks that are near the 52-week low. So obviously when we are in a euphoric, greedy zone, you will see many stocks will be near the 52-week high. But when we are in a bearish zone or in a fear zone, you will see many stocks touching their 52-week lows. So that is an indicator that will sort of represent the strength of the stock prices. Third thing that they look at is something called stock price breadth, right? Stock price breadth means that we are trying to understand the breadth of the market. So when you watch the news, you see the advanced decline ratio is always published by different news channels. Decline ratio means number of stocks that are going up versus the number of stocks that are going down today. You will see in a good day a lot of stocks that are advancing in compared to those which are declining, and in a bad day you see more declines in comparison to the advances. So the advanced decline ratio is also a very important indicator that sort of represents the breadth of the stock price trend. Now another indicator that is looked at is something called the put and call ratio. The ratio of the open interest in the put options in the market versus the open interest of call options in the market, right? More and more people are buying puts. That means that the sentiment is negative. People expect the markets to go down. But if more people are buying calls in comparison to puts, that means that the sentiment is stronger. Another indicator you might be looking at is the VIX index. Right? The VIX index literally shows the amount of fear in the market. Whenever the VIX index is rising, it means that people are getting more and more fearful, volatility is rising. On the other hand, when the VIX index is low, it means that the fear is at the bottom, there is not a lot of volatility. The VIX index is the average implied volatility of options in the current expiry. Finally, you have a couple of indicators which compare equities to bonds. So there is something called safe haven demand, the trend of the stock prices versus the bond prices. When stock prices are rising in comparison to bond prices, that means there's a lot of strength in the market. But when bond prices are rising in comparison to the stock market, that means there is more fear. Similarly, there's another indicator which is on junk bond demands. Junk bonds are high yielding bonds typically issued by companies with lower credit ratings. So these bonds are fixed income instruments that give you very high interest rate, but then they are inherently risky because of their low credit ratings. When people are willing to take a lot of risk in buying these junk bonds, it represents there is a lot of greed in the market, and when this demand goes down, it tells you that there is more fear that is out there in the market. So the fear and greed index is an aggregation of these 7 indicators that we discussed. So having understood how the fear and greed indicator is created, let's try to understand how we can actually go and use this indicator. So the first use of the indicator is totally following Warren Buffett's advice, essentially buying when there is a lot of fear and selling when there is a lot of greed. We actually did a back test of trying to understand what would be our XIR returns if we bought when there's a lot of fear and we sold when there's a lot of greed, and you would see obviously you get a much higher XIR returns if you are buying in fear zones and selling in greed zones. So that's a very interesting strategy that you can follow, and this indicator can be very, very useful because it is removing the emotional bias. Typically as investors, if you're not following a system, you would get biased. If you're seeing a lot of people panic selling, then you might also get that bias and start doing your panic selling. But if you're following this indicator and you know that in times of extreme fear it is a great time to buy, then you will take advantage of this opportunity and you will end up getting in at a short-term bottom. You can also use the fear and greed indicator for your ad hoc rebalancing or sort of trying to define your entries and exits in the market. Finally, you can also use this indicator for your risk management. When do you deploy hedging? Potentially when you're seeing a lot of fear in the market. Similarly, when do you reduce your exposure to these hedges? Potentially when you're seeing greed coming back into the market and things getting cleared up. It's also very important to note that you should supplement this indicator with other strategies, right? So while this indicator is talking about the market breadth, there are bigger forces at play. For example, macroeconomic reasons. Many times you would see that even though there is a lot of panic or fear in the market, if the macro situations are getting worse, then that fear can get even higher, right? It can go down further. So understanding the broader direction of the market in terms of macros is very important. Similarly, if you're using this indicator to time entry and exit into a particular stock, understanding its fundamentals is extremely important, because if there is something fundamentally wrong with the stock, then your fear and greed indicator won't be able to do much about this. Now let's quickly take some examples to understand the importance of fear and greed in the market and how that can help us invest in a more efficient fashion. We hear a lot of people talk about their recent times, which was the COVID crash. A lot of investors that I know ended up selling at the bottom, which was the worst time to exit the market and actually the best time to enter the market, because fear had taken market at a low and the market sort of recovered after hitting that bottom. If you understood the long-term potential of the market, you could have bought at the bottom and taken advantage of this amazing rally that happened after the COVID bottom. Now another example of excessive greed in the market would be 2017, which was the cryptocurrency boom. Everybody thought that the cryptocurrencies are going to go up, and we had a crazy euphoric trend going out in the cryptocurrencies. If you were tracking the fear and greed index, it was at the top at that point in time. Obviously, a lot of investors ended up buying at the top of 2017 for cryptocurrencies, but in fact that was not the best time to buy, and the crypto market tanked deeply after that. So understanding that there is excessive greed in the market and taking that as an opportunity to book profits and not getting influenced by the biases is where understanding fear and greed can be very, very important. Now, like I said, that this indicator does not work alone. For example, when you're looking at 2008 crash, you would see that the fear increased and it stayed high for a while, right? The market was in a deep correction for a few months. There were a lot of macroeconomic scenarios at play. It was not just about mean reversion in the market. Large macro forces were leading to this market correction. So in essence, understanding the broad indicators that will help us ascertain the amount of fear or greed in the market can make us much better investors. If you follow along Warren Buffett's sage advice, buy when others are fearful and sell when others are greedy, you can add a few percentage points on your aggregate returns. If you like this video and you found this useful, please do write down in the comments what else we can do to help you understand this better and how understanding fear and greed in the market has influenced your behavior as investors. Please do hit the like button, subscribe to our channel and share it across with all of your friends. So here's hoping that you are able to buy when the market is in the fear and sell when the market is in greed. Until then, happy investing.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing.